Is it safe to invest in Wealthfront? That is the question on your mind, isn't it? You are standing at the edge of retirement, or maybe you have already crossed that finish line. You have spent 30, 40, 50 years working hard, sacrificing, and saving every single penny you could. And now, you are looking at this digital world, this company called Wealthfront, with its flashy high interest rates and automated investing, and your gut is telling you to hesitate. Good. I want you to hesitate. Because when you are at this stage of your life, you do not have the time to make a mistake. You do not have a 10-year or 20-year runway to win back money that you lose to a scam, a tech failure, or a bankrupt company. Your primary job right now is the preservation of your capital. So, you want to know, is your hard-earned money actually safe there? Let's strip away all the tech jargon, all the bells and whistles, and look at the raw, hard truth. First, let's deal with the burning fear keeping you up at night. What happens if Wealthfront goes belly up? What if the company goes out of business tomorrow? We see tech companies and fintech startups struggle all the time. Just look at the headlines. If Wealthfront disappears into thin air, does your retirement money disappear with it? To answer that, we have to look at how Wealthfront is actually structured, because they wear two different hats. They have a cash side for your savings, and they have an investment side for your stocks and bonds. You must understand how your money is protected on both sides of that fence, because the rules are completely different. Let's start with the cash side, their cash account. Wealthfront is not a bank. Let me repeat that, Wealthfront is absolutely not a bank. They are a brokerage firm. So, when you put your cash into their system to earn that high yield, they do not keep it in-house. Instead, they automatically move, or sweep, your money into a massive network of actual, traditional, brick-and-mortar partner banks. Why do they do this? They do it for your protection. Normally, if you walk into a regular bank, the Federal Deposit Insurance Corporation, the FDIC, insures your cash up to $250,000. If you have more than that, you are exposed. But because Wealthfront slices and dices your cash deposits and spreads them across dozens of different partner banks behind the scenes, they provide you up to $8 million of FDIC insurance. If it's a joint account, it goes up to $16 million. So, if Wealthfront as a company goes bankrupt, or if one of those partner banks fails, your cash is legally backed by the full faith and credit of the United States government up to those massive multi-million-dollar limits. From a pure structural safety standpoint for your cash, that is as secure as it gets. But now, let's pivot to the investment side, your IRAs, your Roth IRAs, your taxable brokerage accounts where you are holding diversified index funds. What happens if Wealthfront goes under while managing your investments? On this side of the house, you are protected by the Securities Investor Protection Corporation, or the SIPC. Wealthfront is a registered member of the SIPC, which protects your securities up to $500,000, including a $250,000 limit for cash that is waiting to be invested. Hear me clearly on what the SIPC actually does. If Wealthfront fails financially, the SIPC steps in to make sure your stocks, bonds, and mutual funds are safely transferred to another brokerage firm. They protect the custody of your assets. They make sure nobody steals your shares. But this is where the big misunderstanding happens, and this is the trap I need you to avoid. SIPC insurance does absolutely nothing to protect you from market losses. If the stock market drops by 20% or 30% and the value of your retirement portfolio plummets, the SIPC is not coming to save you. That loss is entirely on you. Do not confuse a company being safe from fraud or bankruptcy with your money being safe from the volatility of the stock market. So, is Wealthfront a legitimate company? Yes. They manage over $90 billion in client assets. They are a publicly traded company now, regulated by the Securities and Exchange Commission and the Financial Industry Regulatory Authority. They are not a fly-by-night operation. They are bound by strict consumer protection laws. Your money is not going to vanish because of corporate trickery. But here is the real question you need to be asking yourself. It's not just, is Wealthfront safe? The real question is Wealthfront safe for you and your stage of life? Wealthfront is a robo-advisor. That means it uses computer algorithms and automated software to manage your money, rebalance your portfolio, and do your taxes. It is designed to be completely hands-off. For a 30-year-old who is just accumulating wealth and wants to set it and forget it, it's a phenomenal tool. But you are not 30 years old. You are looking down the barrel of retirement, or you are already living on your savings. Your financial needs right now are complex. You need to know how to sequence your withdrawals to minimize taxes. You need to know which accounts to pull from first, your traditional IRA, your Roth, or your taxable cash. You need to make sure you don't trigger massive Medicare premium surcharges. An algorithm cannot sit down with you and look you in the eye to map out a personalized retirement income stream. Wealthfront software is built to help you grow your money, but retirement requires a pivot from growth to income generation and preservation. If you decide to use them, you must be the driver. You cannot just blindly trust the software to know what your life looks like. If you have cash that you need to live on over the next 2 to 3 years, that money should be sitting safely in their cash account, fully insured, earning interest, completely insulated from the stock market. Do not let that cash get swept into an investment portfolio just because you are chasing higher returns. At this point in your life, market risk on money you need tomorrow is a gamble you cannot afford to take.